We've been in New York City over the last few days meeting with financial advisors, and one of the topics that came up quite frequently is style drift inside BDC portfolios. Steve, can you talk to us about why there's a lot of style drift today in these portfolios and why there's these overweights to liquid credit that we're seeing?
Hi, Jack. Thanks for having me on today. Clients need to know what their GP has invested in the BDC and what they plan to invest in going forward. When new M&A volume slows, some BDCs may allocate from first lien loans to higher yielding but potentially riskier junior capital loans. Low volume may also force a shift from what was supposed to be mostly a private credit portfolio to one with a much higher allocation to liquid credit or BSL. Today, we see some managers have between 25% and 40% of their portfolios allocated to BSL. While BSLs may be very high quality assets, they may also be more volatile with market prices moving daily. This could lead to fluctuations in NAV for the BDC and could result in lower returns than a BDC that is invested in 90% private credit. Some BDCs may also consistently operate below their target leverage profile for an extended period of time after the initial ramp period. Low fund leverage could be the result of insufficient private credit originations and may force managers to buy more BSLs. This could be a shift driven by low new M&A volume and not an intentional strategy change. So why does this matter? Importantly, for the sophisticated client, BDCs are priced and structured primarily for private credit investments. If a manager allocates more than 10 to 15% to liquid credit, it may signal difficulty in sourcing proprietary private credit assets. Investors then may be overpaying for an investment that they could get more efficiently through a dedicated liquid credit fund. At Antares, our goal is to maintain a low percentage of BSL investments within the BDC portfolio. This is supported by sourcing from our private equity partners, our strong originations team, and our long-standing incumbent borrower relationships. We followed one strategy at Antares for nearly 30 years. We invest in first lien senior secured loans to sponsor-backed middle market companies in North America. Antares maintains one of the largest and longest tenured originations teams in the industry. This team has built institutionalized relationships with our private equity sponsors who know Antares credit box and they send us deals that fit. Our portfolio includes nearly 500 incumbent borrowers that help support consistent deal flow across all market cycles, even when new LBO volume is low. So to tie it together, what do investment advisors need to watch for? They need to look closely at portfolio allocation. They need to ask whether the manager is disciplined in building a highly diversified portfolio of first lien private credit assets. We think managers like Antares that have strong originations and consistent deployment strategy stand out. Jack, back to you.
Steve, thank you for those insights. We look forward to exploring future topics with you that we uncovered during our travels. Thank you very much.